Welcome to the weekly video update. This is being prepared Memorial Weekend 2022. We'll look at the action in the market for the past week and then see how things look for the week of May 31st through June 3rd. We have a shortened week because of the Monday holiday. Let's go back and look over this week's session. For the week, the S&P broke a 7-week losing record. Now, a lot of people are just thinking that the bounce that we saw this previous week is just a dead cat bounce before we get set to go lower. There's also a lot of evidence to suggest that maybe we've put in some kind of a significant bottom, and maybe there's some positive news coming out of the Fed, and that might be what the markets need to go higher. You have a lot of people that just don't believe this, and when everybody is thinking the same thing at the same time, the opposite tends to happen. So the week ended strong after the release of the FOMC meeting minutes on Wednesday, May 25th. We saw a little bit of a gyration right off the bat, but then Thursday and Friday ended up being very strong. A possible positive scenario may be developing, and if you watch the daily videos, I go through those every day where we're looking at what things can give us some clues that the market might be headed higher. And there's been some news coming out of the Fed lately, and please watch the video where I talk about the fixation on the Fed. I just prepared that this weekend, and I go through some history and some reasoning and some conclusions that I've reached based on how things look right now, and you may find that helpful. The technical picture is negative still on the weekly charts, but it is showing some improvement. We ended up being up 6.58% for the week. Volume was about average. What we're seeing on the daily charts is below average volume pretty much every day, regardless of if we go up or down. So we're looking at the technicals, which again are negative but showing some improvement. The markets are still fixated on inflation and interest rates, and this is producing some growth concerns. We have a lot of geopolitical concerns, of course. The supply chain issues still exist, but it seems as though China is lessening the lockdown, so that might help things that way and possibly help the Chinese economy, which could allow the supply chain in the U.S. to improve. We also have to watch out for any Fed speak. If somebody on the Fed gives an interview or gives a speech, that can sometimes really push the markets positive or negative, and we're watching Fed policy. Their current policy stance has been to raise interest rates right now to get inflation under control with the idea of, okay, after that's under control, now we'll worry about growth in the economy. Now, what we're seeing is a scenario where it looks like inflation may have topped out. We don't know. We could get a slew of economic reports this coming week and following that show things are really strengthening and blows that whole scenario out of the water. But lately, the trend has been that, yeah, inflation is high, but it appears to be coming down. That could be a real positive influence on the market, and it's even suggesting that maybe the Fed will take a pause in their rate hike policy. And then earnings. Sometimes we go through good periods. That's what happened later in the week. Other times, earlier in the week, it didn't matter what the earnings report said. The stocks were still getting hit hard anyway. Our trend condition is a strengthening trend still, even though we saw a bit of an improvement, and it's still negative. One thing that did come out was consumer sentiment, where it just shows that consumer sentiment is really going down as interest rates are going up. We're seeing a real disconnect between these two. The lines are really far apart from each other. Eventually, it'll work its way out, and these lines will come back closer to each other. But what's going to have to happen? People are going to have to feel better about things, or interest rates are going to come down, or a combination of the two. This is the intraday chart, and I have some extra notes on here just because we had the meeting minutes that were released. Monday and Tuesday, we had a bit of an up day, but then Tuesday was down, although we did try to recover. Wednesday was really pretty quiet, and then we had the meeting minutes that were released. The market gyrated around, and then ever since then has seen a real move to the upside, and we ended up closing right at the highs on Friday. So for the week, the Dow was up 6.2%, the NASDAQ up 6.8%, the S&P up 6.6, a little less than that, and small caps, or the Russell 2000, was up 6.5%. This is something that I found at IsabelNet, and it just shows what happens after we've had big weekly gains. The S&P was up over 6%. Well, this has happened a number of times, with the latest one being right here on the bottom at 6.6%. We don't really know what's going to happen, but what has happened in the past? Now, I'm not a big believer in this because I don't manage money the same way that a money manager does who is looking out 3, 6 months, 12 months into the future. I mean, I do that, but I can be more nimble as an individual investor. I can make changes a lot quicker, where somebody managing billions of dollars, they have to plan out to say, okay, what's the best case scenario, or what's the best scenario in a worst case? And saying, okay, how can we have losses but minimize those losses? Well, looking out here into 3 months, if you look at the bottom, the average return after we've had a 6% or more gain for the week going back to 1950, the average return has been 5.6% 3 months later. With the median, and that's more of the real price, is 10.8%. 17 times it was higher out of 23. And so almost 74% of the time, the markets ended up higher. Now let's look at 6 months. 12.5% is the average return, with the median being 16.6. The times that it was higher was 18 out of 23, or 78.3% of the time. Going out 12 months, 1 year. The average return is 21.7%, with the median being 22.2%, and we were up 82.6% of the time. Again, you can use these. Some people really like to study the markets this way. I think it's interesting, but I don't find it personally useful for the style that I teach in my classes. Going back and looking at the week, and I chopped this off a little bit on the bottom, the small caps, which is good. When we see the small caps going up strong, that helps some of our possible positive scenarios, but it just means that people are willing to get into more riskier stocks because they're smaller. They're not as established, or maybe not as big as some of the other companies, and they did the best. Followed by the mid caps. That's also good when we see really solid growth there. NASDAQ 100, which has been getting really beat down this year. The NASDAQ itself, which has just been getting hammered. Then here we have the S&P in pink, and then the Dow and the NYSE. So it was pretty broad-based. Looking at the sectors for the week, discretionary, which has been doing really bad for 2022, it did the best. It was up 9.5%. Energy, which has been very strong, and it was up about 8.25%, with financials up over 8% for the week. Tech, which has been really struggling lately, it was up 7.94%. All of the sectors were up. The one that was in last place was healthcare at 3.27. Communication, which has had some real struggles lately, it was up 3.79. And here's just a graphical representation. And you don't see discretionary in the lead much these days when we're looking at this kind of chart. It's usually way in last place, but it did quite well, with communication up, but not up as much as the others. Looking at the current market valuation, they're still saying that the markets are fairly valued as of Friday. Looking at their different indicators that they use for their model, it shows that the yield curve is still fairly valued. The Buffett indicator has been coming down when you compare stocks to GDP, and it's also fairly valued. The PE ratio is still considered to be overpriced. Interest rates are considered to be fairly valued. Margin debt, which was updated at the end of April, it's been coming down to fairly valued. The mean reversion, how far we are away from the mean price, is still overvalued, even though we were much more extreme. So this really hasn't changed all that much. Looking at sentiment, as of Friday, we are still in extreme fear territory. Here's a historical look where we've been camped out below 25 for a long time. Usually we see dips come down, excessive fear, capitulation, everybody's talking about it, and then we bounce up out of that. That's not what's happening. We're down here frightened and staying frightened. Here's another thing that I found. It just shows the S&P return following sentiment extremes. We're seeing sentiment extremes. 1 month out, where we've had between a 2 and a 2.5% return. When we're more positive, we don't see as good of a return. Looking at 2 months, we have an even higher rate of return, up around 3%, and not as good of a return when we're not extreme fearful. Looking 3 months out, it shows that we're up into the 4.5% range after we've had an extreme sentiment reading, which is what we've been seeing now for quite a while. Doesn't mean it's going to happen this time. This just shows what typically happens. Another thing is we've seen the largest inflow to equities in 10 weeks, where we had been really seeing money coming out of equities. Now we're seeing money start to flow back in. And this dark line is a 4-week moving average, where the lighter blue line, that just shows the raw number for the week. And we saw a lot of money coming back into the market. Another thing that came out, as always, is the Ridex bear-bull ratio. It did spike up a little bit. We were seeing some real negativity earlier on, and mutual fund investors that use Ridex mutual funds, they reacted to that. We had come down a bit, but then we spiked back up this previous week. The AAII survey is still showing extreme pessimism. That could work to the market's advantage as well. The VIX, on a line basis, it's still pretty high, but it's coming down. The bar is also coming down, and we closed right at the bottom of the bar. The Ulcer Index is still showing that there's a lot of fear. Financial Conditions Index, when we're below this black line, that means that things are still okay. We are going up, but we haven't gone across the black line yet. Also, we look at the spread between risky loans and not as risky loans. Yes, it is going up, but it's not getting extreme. We also had the weekly active asset managers survey, where they had gone really extreme negative last week. We saw a bit of a bounce, but they're still pretty extreme negative overall. And down here is the S&P 500. We use this as a contrary indicator. Even though these people are very smart and they're money managers, they're human beings and they have a tendency to overreact just like normal people do. Well, they did overreact, and now they're starting to get back into stocks, and that could help the stock market. We're also seeing the insider transactions ratio for legal insider trading. These are corporate officers and the CEO and people that are inside the company, but they also have to announce what they're doing. When this line gets below, as it is right now, reading a 7, that is very bullish. When it gets way up high, that is bearish. Well, right now, this is giving us a bullish signal, which could help stocks. Looking at earnings and valuation, I went to FactSet, and their latest blog post just says the highest number of S&P companies, when they're giving their earnings conference call, they're citing Ukraine. And it's the highest that they've seen in over 10 years. Well, back in 2014 is when Russia invaded Ukraine before, but that kind of settled down, although it never really did end. And now it's just picking back up. And you have 281 companies that are mentioning Ukraine somewhere in their earnings call. Here's another thing to just kind of compare, where looking at the green line, this is how many times are they mentioning inflation, and that has really spiked up. The blue line is how many times are they mentioning supply chain, and I covered that in last week's video. And then this dark line is how many times are they mentioning Ukraine. They hardly talked about it at all up until the war started. And we're seeing all of these things being used to justify why earnings in companies may see some weakness, or in some cases actually see some growth. Here's another chart that they show at FactSet that's more graphical. The hot topic right now is inflation. There's been 398 mentions from March 15th through May 24th in their earnings calls. The top growth sector, it's been energy, not a real surprise to us. It's been the sector with the highest growth at 268%. 68 companies provided negative earnings per share guidance for the first quarter, the highest number since late 2019. We also have 21 GAAP, generally accepted accounting principles versus not generally accepted accounting principles. For 21 out of the 30 Dow companies that report non-GAAP EPS, the median difference between non-GAAP and GAAP was 17.3%. And some people might think that's important. We don't really use that as much because we focus more on the S&P 500. 9%, the key takeaway. The S&P reported growth in earnings of 9%. This might sound good, but it's the lowest since late 2020. Also, 77% of the S&P 500 companies have exceeded their EPS estimates. The average is also 77. We're coming right in line with the 5-year average. Looking at the Fed, we're still at a very high probability that after the meeting in the middle of June, that we will be at 1.25 to 1.5. Here's the historical chart. If you'd like to pause this and check that over. Also, looking out at the July 27th meeting, there's an 89.4% chance that we will be at 1.75 to 2% after that meeting. And here's the corresponding historical chart. The Fed balance sheet actually declined $31.6 billion from the previous week. Looking at breadth, this is where we're seeing some improvement. If you look down here on the bottom, this is actually showing a positive divergence where we were hitting a lower low based on price, but we're hitting a higher low based on price down here. That could be positive, but we're seeing a real improvement in breadth overall. We've gone back above the moving average. Based on volume, we're also seeing a real improvement and we've been able to go above the moving average. Looking at the advanced decline ratio, it is turning positive and heading higher. New highs and new lows also starting to turn back up based on our 4-period simple moving average. And looking back 10 weeks, we are turning up, but we haven't quite crossed above the zero line yet. Accumulation distribution, it's still negative, but showing some improvement. We're trying to cross above the moving average. Looking at the trend, it is still negative. The red line's on top, but it is declining. The green line's on the bottom. It is bouncing a little bit, but overall, the ADX on the weekly chart shows that we are in a trend, and that trend is negative. The Arun has really declined a little bit. It's showing a decrease in selling pressure, but also a decrease in buying power. And overall, when you compare the two, we're seeing our oscillator decline, and we are below zero. The mass index still has not generated a signal. It has on the daily charts, but not here on the weekly chart. Long term, there was a change on Friday in the decision point scorecard where their PMO signals in the short term have turned up. Looking at our different pivot points, we did really see a breakdown below S1, but we were able to recapture that this previous week. If you look down on the bottom, volume was just about average to a little bit below. We're still well below the 50-period simple moving average, but we did see a bounce up. Here's the long-term trend. We still are in a downtrend overall. And you're going to see that in a lot of these charts right here. Bullish percent index really saw a big bounce in the previous week. It's above 50. That's considered positive and could really help the market go higher. The Chaikin oscillator, after giving an extreme negative reading, is really starting to bounce up. Chaikin money flow is showing some improvement, but it's still negative. The force index is bouncing up, but is also still negative. The McClellan oscillator giving us an extreme positive reading. And looking at the summation index based on price, we are turning up, but we're still below zero based on price. We're just slightly positive based on volume. And the cool thing about this chart, not only on the weekly chart, but the daily chart, a lot of times volume will actually lead price. Our oscillators are trying to turn up. The slope is trying to go back positive, but the MACD is still negative. KST, TRIX, PMO, and the TSI turning up a little bit there. They're still pretty much negative overall. Here's our PMO study. Again, showing that the PMO is negative. We're trying to bounce up a little bit based on price as well as volume. Those PMOs that are rising, this is actually extreme positive. We are seeing a real improvement and a more positive signal with those PMOs that are generating buy signals, and we're seeing a turn up in those PMOs that are above zero. The RSI, after almost getting extreme negative, has been bouncing up. The special K continues to be positive but is rolling over slightly, but it takes a long time for this thing to really move. The Swinland Trading Oscillator showing a pretty extreme reading now based on price and volume. It just shows that the rebound that we saw late in the week last week was picked up on our weekly charts. The Stochk RSI is looking more positive and it's above the dashed line. The Williams percent R, after being extreme negative, is also showing some improvement, but we have not got back to the minus 50 level yet. Vortex indicator is seeing a decrease in selling and increase in buying, but it still remains negative overall. Ultimate Oscillator also turning back up, even though it never did get extreme. Money flow still is showing a decline. Bollinger Bands, after almost getting extreme negative, have also shown some improvement. The KST continues to decline and has really not been all that helpful lately. The PPO, the percentage price oscillator, is still negative but trying to show some improvement. Rate of change looking back 1 week shows that maybe we overdid it this past week. We might see a bit of a pullback and let this chart readjust. Going back 50 periods, we are showing some improvement, but we're still below the dashed line, which is negative. The Copic curve, which has generated a signal on the daily charts, is trying to turn up, but it's not really giving us a strong signal yet on the weekly chart. Looking at our fib levels, we came down last week and hit right at this 38.2% retracement. That's when we saw a lot of buying really come in, and we're seeing a real advance out of that. Can it continue? Looking at the different charts, the Heiken Ashi is almost like a doji right here. We pretty much closed where we opened on the weekly chart. The Kegi is still negative. The Renko is still negative. The point and figure added some new X's, but there's no signal that's been generated, but it is looking slightly better. The 3-line break also putting in a solid open bar, and that's showing improvement. Our different trading system shows that the Elder on the S&P has switched back to neutral, where it had been negative. Parabolic SAR continues to be negative, where it has turned positive on the daily charts. Looking at some broad measurements, here's the S&P on the top, the mid caps in the middle, and the small caps. I don't have any studies on here. This just gives us a visual representation of what happened using a bar chart. The all stocks, which takes into account U.S. as well as non-U.S. stocks, it's still in a downtrend, but did see a bounce. Mid caps, in a downtrend and a bounce. Small caps, same thing. Downtrend, but a bounce. The Dow, downtrend, bounce. NASDAQ, downtrend, bounce. NASDAQ 100, downtrend, bounce. NYSE, downtrend, bounce. And almost getting close to the 13-period moving average. The Wilshire, downtrend, bounce. FANG stocks had a pretty good week, up 7.83%, but still have a long way to go to turn back positive. ARK also had a good week, up over 7%, but a lot of damage has been done. 30 biggest software companies is still in a downtrend overall, but did see a bit of a bounce. Looking at some other markets, the CRB is still in a solid uptrend overall, both on the daily chart as well as the weekly chart. The gold ETF, we're staying above this longer-term 50-period moving average. That's 50 weeks. And we're also playing with the 200-day moving average on the daily chart. The silver ETF is in danger of showing us a death cross, where it is giving us a death cross on the daily chart as well. It's really been falling down lately. Oil is still very high at 115.07. Imagine that. Memorial weekend and oil prices go up. Who would have thought? The dollar, which had been just going higher and higher, really saw a negative week this past week, but it's still in an overall uptrend. Looking at some relative studies, bonds have really underperformed stocks. We saw a little bit of a breakout, but now that is going back down. On a monthly basis, we're seeing that stocks are really outperforming bonds. And both aren't doing all that great right now, but stocks are doing a little bit better on a relative basis, or you could say bonds are even doing worse. Intermarket analysis shows that oil has been performing the best, followed by the dollar, and then gold, which has been positive. And then those things that are negative but trying to show some improvement include the S&P 500 And in last place are the bonds based on price. The gold against the dollar ratio. Gold has been having some trouble. The dollar's been declining, so we're seeing gold bump up just a little bit because it didn't do as bad as the dollar did in the previous week. The gold to the S&P 500 ratio is still in an overall uptrend, but did see a decline. The low volatility ratio, they've been really outperforming in 2022, but showed some weakness this past week. The growth to value ratio is showing where growth has been really underperforming, but saw a bit of a bounce. The NASDAQ 100 to the S&P 500 saw a little bit of a bounce, even though it's been underperforming overall. The S&P 100 has really been underperforming the S&P 500, and that did not see a bounce. Discretionary against staples have really underperformed, but saw a bit of a bounce. And then we're looking at energy against tech. Energy is clearly in the lead. Tech has been having a lot of problems, where energy was not the place to be in 2018, 2019, and even into 2020, but energy has been the place to be in 2022. So what's our outlook then for the coming week? The major economic reports that are coming out include the Chicago PMI and consumer confidence. That'll be coming out on Tuesday. Then on Wednesday, we have ISM manufacturing. That's a biggie. Then on Friday, we have the big jobs report, the employment situation report. So there's a lot of data that's going to be coming out in a shortened week. Things to watch. The technicals, yeah, they're still negative on our weekly charts, but showing some improvement. The markets are still really concerned about inflation and interest rates, but that might be getting better. But some of these reports coming out could just blow that whole thing out of the water. Geopolitical concerns like Russia, Ukraine, the supply chain, different events that are going on, they could be either positive or negative to the market. We want to keep an eye on oil, which has been really, really high. And then different Fed speak as they give speeches or interviews, and then policy, which may be coming out. Are they going with this idea that maybe inflation has topped out and they might be able to pause with their interest rate hikes possibly this fall? The market would really like that, and that would give a lot of support to the market. Earnings as they're coming out, and then we're watching the longer term scenario with Japan. I don't really talk about that in the weekly videos, and I'm doing some more research, and we'll be talking about that more in the daily videos, and possibly even doing a supplemental video. So our scenarios, we are still down right now because of rising interest rates, inflation fears, growth concerns, earnings, the Fed, and then the recent trend of selling into strength. That's what a lot of people think will happen when everybody returns on Tuesday. They're just going to say, oh, we had a good couple of up days. It's time to sell some more. And that could be what ends up happening. The technicals are negative, but looking better. Things to put into our positive scenario are that, yeah, the technicals are turning more positive, especially on the daily charts, and sentiment is still extreme negative. And we use that as a contrary indicator. We have our possible positive scenarios, and you'll have to really watch the daily videos to get more into this. The Copic curve is giving us a signal, as is the Pring bottom fisher. The staple spike is also looking viable right now. Now, that could always change. The mass index has also triggered a signal, and then it looks like 2-year yields may have topped. But then again, they could spike up again and blow this out of the water. And then the Fed pivot that I've been talking about. And if you want to learn more about that, please watch the supplemental video that I posted over this weekend. The technicals, pivots, short-term moving averages, fib retracements, previous levels, they may provide support and resistance. And we're not in a sideways market now because the ADX is still above 20. So thank you. Have a wonderful week. Please tune in to some of the other videos if you think you might find them helpful, and I'll prepare the next video next weekend.